So I'm Brian Jacobsen, Chief Economist at Annex Wealth Management, and at Annex we provide a whole array of financial services, wealth management, investment management, and I am a key member, just a member though, of the investment committee and the investment team. We also have Matt Morsey, our Director of Research. He's up here, he's on our investment team. And so we work together to try to help clients navigate the markets, and we figured a great presentation title that is pretty evergreen that we don't have to change every single month is Navigating the Markets. That is not a picture of me as far as with the posing with the little what do they even call that on a ship? And I get seasick too, so I would not be the best captain of a ship. But I do pay very close attention to what's going on in the world from the macro perspective. So my main role is to really take that top-down view of what's going on, but we also have a strong team of bottom-up analysts, and so we try to bring those perspectives together. And honestly, I oftentimes find that bottom-up perspective to be a lot more valuable, mainly because it's a lot more interesting. You can hear stories. Also, it gives you really interesting insight into maybe what to expect from the macro picture. And so that's what this presentation is about. It's only about 10 slides in total. So please do ask questions as we go along. It's a small enough group. You can raise your hand, or you can just just speak up. Sometimes I start if I'm looking, I tend to not see hands that are raised. So it's probably best just to speak up instead of trying to raise your hands. It's not a classroom, right? Of course, I do have to have the standard disclosure slide. Our compliance department requires this, and I think that they have ninjas walking around just in case I don't. Basically, this is for hopefully entertainment and educational purposes. It's not individual investment advice. Don't take it as such. If you want to become a client, that would be fantastic. Then we could give you that individual advice, but this is for educational purposes. And the gist of it is that if anybody asks, I was never here, I will deny it. All right, so let's start by kind of taking a look at what happened in 2024 from a markets perspective. I'll also talk a little bit about from an economic perspective, but this is mostly about navigating the markets. 2024 was incredibly unusual from a statistical perspective as to how different parts of the market performed relative to other parts. We took a look at data going back to 1927. So this is based on annual data, seeing how often is it that large stocks, so as represented by like the S&P 500, that's a typical proxy for big companies in the United States. How did they do relative to smaller companies? A usual index that's used for that is the Russell 2000. It's just 2,000 of some of the smaller stocks that are publicly traded. Keep in mind, there are in the United States only about 4,500 stocks that are traded. That's down from like 8,600 back in the late 90s. So the number of stocks that are publicly traded in the US has been declining over time. A lot of that is due to the paperwork and regulations involved in being a publicly traded company. More and more companies are deciding to stay private or even go private. Maybe things will change on a going forward basis, but that's been the story for about the last 20 years. Kind of this declining pool of the number of publicly traded companies that have been out there. The last time that we saw large cap companies outperform small cap companies by 13 percentage points, it's been a while. It's only happened like 13 out of the last 100 years. Okay, so that's a fairly rare event. We had the S&P 500 return more than 20% last year, more than 20% the year before. And that doesn't mean that in the next year it's going to be less, like negative. It's just, the history suggests that the momentum begins to fade a little bit. So we shouldn't expect a repeat performance. I mean, that's why it's unusual. Unusual things don't typically repeat. Last year, we also had the S&P 500 big companies, the stocks, outperforming government bonds by more than 31 percentage points. So that is a huge difference. That's only happened 12 out of the last 100 years. So again, another very rare occurrence. Why did it happen last year? Well, part of it was just because stocks did so well. And bonds, if we use a broad market index for the United States, it's called the Bloomberg US Aggregate Index, that only returned about like 1.5% last year. So that's with the coupon that the bonds pay off, and then plus any changes in the prices. And as you probably know, over the last few years, those interest rates on bonds, they've been moving around quite a bit. It's been like when I went down to Disney World many years ago, there was that Mr. Toad's Wild Ride, right? It was up and down and all around. And that's kind of what has happened with the bond market. So yields going up, yields going down. And when yields go up, the prices of the bonds go down. So very unusual, but it was mostly driven by very strong performance by equities and weak performance by bonds. Then in terms of, if you look at the companies that make up some of these broad market indexes, like the S&P 500, the top like 3 names can be a disproportionate amount of the index itself. If you were invested in a well-balanced portfolio, you probably underperformed those indexes that you see oftentimes on the ticker on CNBC or Bloomberg or Fox Business News, whatever your favorite news network is. Because most portfolio managers want to manage what's called concentration risk. They don't want to put all their proverbial eggs in one basket. And in a way, a market cap weighted index, so it's based upon the overall size of the business, that can create some concentration risk where you have like 40% of the S&P 500 for just like the top 10 names. That's fairly concentrated. And it's awesome to have that type of concentration risk as long as things keep going up. The problem is they don't always keep going up, right? They can stumble. And so that's where the risk can become the reality of a problem. But in terms of how is it that that market cap weighted portfolio performed relative to, if let's say those 500 stocks, if you just put like 1/500th in each one, okay, so an equally weighted one, that 12 percentage point performance difference, that's only happened 2 other times in the last 100 years. So that was a very rare occurrence. Now, growth stocks versus value stocks, that's a distinction that's oftentimes used. Value stocks, if you think of those as, let's say, the earnings of the companies, the price relative to those earnings, if that ratio is very low, those might be considered value stocks. If the ratio is very high, because investors are thinking that, well, the value isn't coming from today's earnings, it's more from the growth of earnings way into the future, those are growth stocks. Okay, so one of the ways to distinguish between those. And that performance difference of 24 percentage points, that's only happened 8 out of the last 100 years. So it was a very unusual year. I would expect, just because it is unusual, that it shouldn't happen again. How might it change? Well, we'll have to see. It's kind of early days. There are a lot of things that are changing in 2025. We have a new administration, and every day we get new announcements about policies and priorities, and we have to see how things shake out. Okay. So in terms of why the markets maybe did what they did, and then the macro perspective on a more going forward basis, the US markets really outperformed foreign markets. So whether it's developed foreign, which would be like Europe, Japan, Australia, or emerging markets. So that would be like in Mexico, Argentina, you could have China in there, lots of those more developing countries. Here I'm just looking at the growth as reported from something called a Purchasing Manager Index. So they go out, there's a company, they go out and they survey a bunch of business owners, the purchasing managers, and ask, are things growing or are they contracting for your business in any given month? So relative to last month, are things getting better or are they getting worse? So anything above 50, it says that more of them are saying things are getting better. If it's less than 50, it means more are saying that it's getting worse. And so this 50 line here is kind of that magic line for indicating whether things are expanding or if they're contracting. And what you can see for the US, that's in yellow, that more often than not, especially since 2023, this is based on monthly data, growth in the United States has just been better. Okay, in Europe, it's been a lot weaker, and in fact, what's I think most interesting is that back here, and if we kind of follow this line down, starting back in April or March, April of last year, they began to diverge again. Okay, so coming into 2024, a lot of economists, not us, but a lot of economists were saying that the US was likely going to experience a recession. And some of the early data in January of last year was pointing to a slowdown. We thought it was a slowdown, not a contraction. very important difference because the US rebounded from that. Then we had another experience in April where some of those economic indicators were pointing to possibly another slowdown. US, we had a slowdown, but then rebounded from that. And so US exceptionalism is no longer an exception, it seems to be the rule in terms of just economic growth. And this can maybe explain why it is that US equities have done so much better than non-US equities, is that we've earned it in the US in terms of that earnings growth to support it. And it will be interesting to see that maybe 2025 is a year in which we can see value begin to really form a foundation for foreign companies, because I don't think the growth outlook is going to improve in terms of a big rebound. But sometimes in the markets, things can get so cheap that it looks like a really compelling opportunity. But they can be cheap for a reason. And in a way, foreign markets have been cheap for a reason because the growth has been slow. But will that begin to change a little bit in 2025? It seems like the consensus, if you look at Wall Street forecasters, they're saying that the US is going to have much stronger growth than they're going to have in Europe, especially if we get changes to tariff rules that could serve as a drag on growth, especially in, let's say, Europe, in China, Mexico, Canada. And so if that is a hit to their growth, there's not really a strong reason to think that they're going to experience faster growth than in the United States. But what if some of these fears of tariffs don't become a reality of tariffs? That's where the market can get caught maybe a little offsides. And you could actually see those foreign markets begin to outperform the US. And the way that I'm looking at things right now is we've only, now granted, I think we don't even have a full week done in terms of the first administration. So it's one down, I think 208 weeks to go, something like that. We've already learned a lot as far as that first date. People thought that President Trump was going to have a bunch of executive orders on tariffs, and he didn't. Right? He's been talking about, yes, maybe we will hike them, maybe starting February 1st, we'll have 25% tariffs on Canada, Mexico, 10% tariffs on China. These numbers and the deadline seem like it's very different than what was campaigned on. I mean, it's the same general theme, but the bark maybe is worse than the bite when it comes to the tariffs. As a result, I think that don't throw in the towel on a globally diversified portfolio, because 2025 could be the year that just when you thought that you should go all in on the US, that was the exact wrong time to do it. I do think the US will probably do quite well in terms of our markets, but I would want to make sure to still have an allocation to non-US equities, just because those expectations could dramatically change. Now, another one of the pillars that I like looking at, so I like looking at growth and inflation for the economy. I wanted to take a look at inflation because there has, obviously, it's been an issue, and it's getting a little better. Seems like towards the end of last year, we were beginning to move, once again, in the wrong direction. We started off 2024 with the Consumer Price Index. So it's just a market basket of goods that your typical household buys. So the CPI, Consumer Price Index, that had increased by about 3.1% from the year before. Then, all of a sudden, we get halfway through the year, it's down to about a 2.4% increase. Things were looking a lot better. But then we started taking a step back when we got into the fall and early winter. And that has led the Fed, the Federal Reserve, so the central bank in the United States, to say, you know what, we've been cutting rates, they're still restrictive, so they're still high enough that they're dragging on growth, but maybe they don't need to keep cutting at the same pace. So what they've signaled is that they might want to cut back on the pace of those rate cuts. Okay? Market initially didn't like that, but the data kind of supported that. If we are seeing a little bit of a rebound in inflation, maybe they don't have to cut quite as much, or maybe they shouldn't if they do indeed want to stay focused on trying to tame the beast of inflation. Now, in terms of, if you look at this chart, it is showing price levels, not inflation. So inflation is the change, like year over year, or it's basically the slope of any one of these lines. That would be inflation. So it's the change in that. Prices are still too high. right? They're still much higher than what they were back in the end of 2019. So that's what I've indexed these to. So food prices, broad basket of food items, your typical household buys, those prices are still up like 28.1%. You look at energy prices, yes, it was nice to have those come down over, from 2022. You can see that that's where they peaked, but they're still about 21 to 22% higher than what they were, in 2019. CPI excluding food and energy, which is sometimes called core inflation, and it's not because economists think that people don't eat or drive cars that they tend to exclude that. It's just the food and energy prices, those tend to be a lot more volatile. So what we're trying to do is figure out the signal and separate that from the noise. And sometimes those numbers from food and energy can be a little bit noisier. But even with excluding food and energy, core inflation has moderated, but it's still increasing, and it's up. The price level is up 21.3% from December 2019. So even if the Fed is saying, yes, inflation is getting better, people can still be like, what are you talking about? Right? Prices are still high. Egg prices, have you seen those? Right? Bacon prices. Those were campaign issues. And the Fed is focused more so today than maybe what they were just a few months ago on getting a little bit more serious about saying we don't necessarily want to keep cutting rates as quickly because we want to make sure that inflation does get towards their 2% target. Even if they get inflation to 2%, that doesn't mean prices are going down, right? They're still going up. Now, you can maybe write your Congress person, your representative, to say that the Fed shouldn't interpret their mandate to be stable inflation. It actually says stable prices, but that's a different issue. But I think that inflation, it is moderating. Don't expect prices to decline. It is likely to continue increasing. Now, what about, let's say, tariffs and immigration? How might those policies affect inflation? The Wall Street Journal back in October did a survey of economists and asked their opinion, based on that. So that was before the election, about expectations in 2025 for growth and for inflation. Now, they surveyed them again just recently and asked, how have those changed now that we have a new administration? Just about every single one increased their forecast for inflation for the year and decreased their forecast for growth for the year. And the average change was saying that instead of having 2.1% inflation, it would be 2.5. So a slight increase by about 0.4 percentage points. For growth, going from about 3% down to about 2.5%. Okay. Now, as an economist, I always kind of chuckle when I see decimal points because we can't really measure those things all that precisely. So you can tell we have a sense of humor whenever we use a decimal point. I like to just get the direction. Is it going to get better or is it going to get worse? I think that's a little bit more helpful. But in terms of if we look at the likely effect of tariffs on inflation, there is no real clear answer that it does indeed create inflation, especially at the consumer level. Like, you have to remember that when we import something, right, whoever is importing that, usually a wholesaler or an import company, that they are the ones who pay the tariff. And then the question is, can they pass on that tariff to final consumers? Okay? And what businesses have been reporting more and more is that their ability to pass on those price increases has gone down over time. So it is quite likely that even if we do get tariffs of any magnitude, that it won't necessarily translate into higher consumer prices. Maybe the businesses are going to have to eat the cost. And so that has investment implications because we care about earnings and cash flow. So if a company's costs go up, they're not able to pass on the revenues, that can compress their margins. Okay, and so that could be one of these lingering risks out there for the market as to how the ability, if we do get tariffs, how much are they, and what is their ability to pass on those price increases? Another thing that can happen, and it's already happened, is the foreign currency can go down in value. So if you're a Chinese exporter to the United States, right, you don't necessarily want to hold US dollars, maybe you do as a store of value in that, but for the most part you want your domestic currency. And so currencies tend to adjust whenever there are tariffs. Last time in 2018 to 19, there was a 10% increase in tariffs. The Chinese currency depreciated by about 4%. So currencies can move as like a shock absorber, where then the problem is for US exporters to China. And so in a way, consumers might not pay the price of tariffs because profit margins can change, but exporters in the United States, if you're selling to China and their currency has gone down in value, what you get from them has gone down in value. So exporters oftentimes pay the price of tariffs. Okay, so something to kind of think about in terms of from an investing perspective. It's one of the things we do on that bottom-up basis is which companies, do they have pricing power? What do their supply chains look like? Are they exporting to China or to whoever's going to be slapped with these tariffs? So it is a big question out there. The broad macro effect is likely not going to show up that much, though, in the data. It is probably more of a micro effect, that it affects individual businesses or industries more than it does the broader economy. Then there's, of course, with immigration reform, the extent to which if you think about what's happened over the last 2 years, the growth of the labor force in the United States has mostly been driven by legal immigration. The Bureau of Labor Statistics, they come up with data as far as employment gains, so not just labor force, but who's actually employed. Since last year, native-born population, their employment has declined a little, but it's gone up for the foreign-born population. Okay, so it's been a good source of employment gains. There is a chance that with immigration reform, that maybe it is a slight deterrent to legal immigration, in which case you could see the labor market tighten a little bit, so we have a very low unemployment rate. It's quite possible that we could see that stay low. So even if the Fed, that if they keep rates high where they are, or only cut very gradually at a slower pace than they did last year, you might not see much of a change in labor market conditions. Okay, so something that we're watching, obviously, as to how that might play out. Next is looking at policy. So another one of the pillars that I look at, so growth, inflation, and then monetary and fiscal policy. I already talked a little bit about fiscal policy, right? Expect the Fed to cut back on the pace of rate cuts, right? Because they are focused on inflation. They don't want to kill the economic expansion, but they have shifted their gaze a little bit more towards watching inflation data instead of labor market data. So that's on monetary policy. Fiscal policy, who knows what's going to happen, right? We know that the Tax Cuts and Jobs Act, so the 2017 law, is scheduled to sunset at the end of this year. And Treasury Secretary Scott Bessent, when he was going through his confirmation hearings, he said that it would be a calamity, like economic calamity, if they don't come together and actually pass an extension of the Tax Cuts and Jobs Act. Why? Because 60% of Americans would be paying a lot more in taxes, right? It would be a tax hike. Even though they're framed politically as a tax cut, it is a continuation of existing policy. So if it sunsets, tax rates go up. Some of the analysis done by the Tax Foundation, which is a nonpartisan group that studies this type of stuff, they estimated that it would work out to basically having an extra mortgage payment every year for your typical American. Okay, so their numbers, they said for your average American, the amount that they pay in taxes would increase by about $2,500, which was about consistent with what a monthly mortgage payment would be. Right? So how would you like that, right? If all of a sudden you had to make one more mortgage payment. And so it is an incredibly important issue. It'll be interesting to see, are they able to get it done in one big bill? Is it going to be spread out? We don't know. Right, but we are going to pay very close attention as to how things are playing out. That does seem like they do agree it needs to be extended, but what sort of additional tweaks to the tax code might they have? Will we see the no tax on tips? Will there also be included a reduction in the corporate tax rate down to, say, 15%? Those are all unknowns. But we do know that they do have a strong motivation to get reelected in the next midterm election, and they're probably going to want to make this a high priority to extend it. So I think we don't want to count our tax cuts before they hatch, right? Don't count your chickens before they hatch. Same thing with anything when it comes to tax cuts. But probably a pretty good bet to say it will get done. It might come with some drama, but you would expect that. Obviously, debt and deficits are a huge issue, especially for the fixed income market. Simply extending the Tax Cuts and Jobs Act isn't going to do anything to really help the debt and deficit. That will require spending cuts. Who knows what appetite is out there for doing those spending cuts? over time, keeping the tax code in place could result in more revenue, but not immediately. Right. A lot of the statistical evidence as far as the effect of tax cuts on government revenue, it suggests that initially there might be a reduction, but over the longer term you can have an increase because you get faster growth, especially if you make a more efficient tax system, don't have so many exclusions and all the contortions that go into it. But looking at it budget year by budget year, simply extending the Tax Cuts and Jobs Act would make it look like the deficit isn't going to get better. So other things will have to come along with it. And I do suspect some people will hold out for something to be done on the spending side. Now, we did this past week hit the debt ceiling. Okay, did anybody else feel that at the top of your head when we hit that debt ceiling? Former Treasury Secretary Janet Yellen now, she had warned last week that we were likely to hit it this week. That doesn't mean that the government is out of money. It just means that they can't issue more debt in order to fund their expenditures. Now, what this is showing is the Treasury's checking account with the Federal Reserve. Okay, so the U.S. Treasury, they have a checking account with the Fed. It's called the Treasury General Account. And they have quite a bit of money in there. It's about $750 billion. So that's a decent amount. But when they're spending, like $3 billion a day, I think it is, on interest expense on the debt, that's going to be spent pretty quickly. Right? Now, based on some, I think, reasonable assumptions based on history about inflows and outflows, they should have enough to get to August, maybe end of July or August, before this account gets back down to kind of closer to zero. Now, they are likely, if they don't issue as many treasuries because of that debt ceiling, and they're spending out of this general account, that is sometimes called like a liquidity boost. So they're spending more money, not issuing debt. So we could see the fixed income market really take a look at that as saying that, okay, there's not as much debt out there. Simple supply and demand would suggest that maybe the yields could come down. We'll have to wait and see if that does play out. But from that more macro and kind of policy perspective, there is no imminent threat of my parents not getting their Social Security check because we have hit the debt ceiling, right? And even if we do get to July or August, where they have spent down the account and have run out of some of the accounting maneuvers that they're able to use, Treasury Secretary Bessent said the government will not default on its debt on his watch. Okay, so what does that mean? Well, back in 2011, the Federal Reserve and the Treasury, they actually had a playbook for how to keep the government from defaulting on its debt. So I'm sure you will hear on television plenty of people saying, we're going to default on our debt. No, they're not going to. There is a plan in place to avoid that. That doesn't mean that it's going to keep them from talking about it, and it doesn't mean that they shouldn't do something about it. It's just that it might be more of a hollow threat than anything. Okay, now in terms of the markets, so that was the macro, right? Growth still looking good. Tariffs, let's see how things shake out. You might have deregulation offsetting any drag on growth from tariffs. Inflation looks like it's heading in the right direction, but it is a bumpy road to get there. And then in terms of policy, monetary policy, Fed probably cutting back on the pace that they cut rates. Fiscal policy, it'll be interesting to watch that debate. Expecting extension of the Tax Cuts and Jobs Act, but really it is going to come down to that, I think, the horse trading in terms of what can they do then in terms of on the spending side. So looking at the markets themselves, a lot of people have been talking about how expensive the market is, the equity market. What I wanted to do was really take more of a data-driven approach to saying, how expensive is the stock market? And a lot of it depends on your expectations for the future, right? When you buy a stock, you're not buying last year's earnings or the year before that. You're buying future cash flow from that company. So it's a question of how much value are they going to create for shareholders in the future. A lot of that depends on two factors. There's a lot more than that, but this is kind of a simple way to think about it. What are their profit margins? Okay, so that's one of them. And then what is the growth rate of those earnings over time? So their ability to really, when they have their revenue, translate that into shareholder value or cash flow or reinvest in the business and then to grow those earnings. And that's what this is really showing, is that in terms of looking at expected growth rates, that's this line here. So for all sorts of different parts of the market, different sectors, different countries, technology stocks, okay, there's an expectation that they're going to have fairly robust earnings growth over the next 3 to 5 years. And so that's the forecast horizon here from the Bloomberg data that I was using. Okay, so rather rapid growth for the next 3 years, whereas there's other parts where there's rather muted growth expectations for their earnings. But there's a pretty strong linear relationship between the price that people pay for the cash flow, that's price to cash flow, so that would be one of these market multiples, kind of a back of the envelope way to calculate a valuation, a relationship between that and their expected growth rates. There's also a very strong relationship, a linear relationship between the margins, like these technology companies. So when you look at their revenues, right, nearly 28% of their revenues get translated into earnings per share. Okay, that's a pretty strong profit margin. That's pricing power right there. A lot of it, right? I mean, think about like NVIDIA. They can't make enough chips to meet the demand, so they can almost name their price. And you have a company like Microsoft saying that they're going to spend $80 billion in this calendar year alone on their data centers. They're going to be buying a lot of those chips. Right. Now, there are other parts of the market where maybe their margins aren't quite as strong. So small cap stocks are an example of that. Their margins tend to be a lot smaller. Only about maybe 55% of small companies in the United States that are publicly traded have actual positive profits. A lot of them are running at losses because it's expected that maybe they can grow over time and then become profitable. And so when we combine these two, margins and growth, that can go a long way to explain why valuations are what they are, where they are. So why is it that Japanese stocks are at low price to cash flows? Well, it's because lower growth, lower margins, technology stocks, higher valuations because they have high margins and high growth. Okay, so that explains why things are priced the way they are, but it doesn't tell us, are they fairly priced? Should they be priced that way? That all depends upon having an expectation of, are those growth rates or margin assumptions for the next year reasonable? Right? So that's where you can have a differentiated view compared to the consensus to hopefully add value in a portfolio. If you think that technology stocks, instead of having margins that are 25%, if it should be closer to 20%, right? That should then perhaps lead to a repricing, so that price to cash flow going down. Okay, or maybe that's not optimistic enough, right? So that it's that differentiated view that helps determine whether or not you can add value in a portfolio. But in terms of, is the market overvalued or not, I would say that based on the consensus expectations for margins and growth, no. But those consensus expectations might be wrong. So perhaps they are overvalued, at least in some areas. Okay. Now, in terms of on the fixed income side, I like these squiggles because they're very colorful. And what it, I think, highlights is just how volatile fixed income markets can actually be. A lot of people think about fixed income markets as being like the ballast of your portfolio. It's going to help reduce volatility. It's going to reduce the risks of your equities, and they should. That's the way that we try to manage the portfolios, is to have bonds be a diversifier to the stocks, so that when stocks zig, bonds hopefully zag, that they can help add value, create that ballast. But this is showing what has happened over time to credit spreads. Okay, credit spreads just refer to, if you are lending money to a business as opposed to the government, you have to worry a little bit more about default risk, right? Because businesses can't print their own money. The government can. And those spreads reflect the risk of default, the probability of getting paid back. And so when those spreads go up, okay, that means that, think about if you are a high yield company today, maybe you're paying 8%, where the government is paying 4.5%. Okay, so that's the spread. And it can get very wide when things are going badly, and they can get very narrow, very small when things are looking a lot better. The problem is when they're very small and narrow, you get a lot more volatility. They bounce around. This is where we are today, very narrow. We've been here before. Okay, we have seen this play out. It doesn't always play out well. It doesn't always play out badly. context matters. As long as we continue to have decent growth, these spreads should probably be fairly stable. Maybe we'll get some of the bumps along the way, but nothing that really worries me that much. An example of that period of time would be this 94 to 97 period. You did see we were very low, they widened, but then they came back down. So it required patience. And that's why 2 cardinal rules of successful investing: diversification and patience, right? The ability to be able to stick to your plan. It's when you get emotional about, when the volatility leads you to make emotional decisions, that's when investors tend to lose money. So we do think in the fixed income market there are still great opportunities, but you don't have to take a lot of risk to take advantage of those opportunities. Government bonds are yielding a pretty decent amount, but so are some corporate bonds. You can get a little bit more income there, and the quality of the companies within the universe of the publicly traded debt out there has improved over time. Debt to equity ratios have come down. You've also seen what's called interest coverage ratio, so the amount of money that they have available to service the debt, that has improved. So in a way, some of this low spread environment can be explained by improved quality of the bonds that are out there. A lot of the lower quality bonds have seemed to migrate more towards the area called private credit. Not all private credit. I don't want to paint too broad of a brushstroke, but we're seeing more of the kind of lower quality stuff migrate more into the private markets, not necessarily in the public markets, which is what you can get access to through mutual funds and exchange traded funds. Okay, so key takeaways, just to kind of wrap it up, then obviously ask questions. Growth, we expect it to stay resilient in the United States, despite possible thing arising from tariffs, trade wars. Who knows? It probably doesn't pay to speculate too much on that. The fundamentals of businesses look good. We expect that to continue. A lot of businesses have learned from the 2018 to 19 period as to how to ride through a possible trade war. Lower inflation, remember, does not mean lower prices. Kind of a key thing, but the inflation environment is beginning to look a little better. We had a little bit of a step back, but we can see that really, I think, improve towards especially the mid to late part of the year. If you're thinking about, let's say, from a policy perspective, the debt ceiling, don't let that worry you too much. Okay, you'll see plenty of media reports about it, how we have hit the debt ceiling and we aren't going to be able to pay our bills. That's a bunch of bunk. And then in terms of the markets, right? With equity markets, we're still constructive on the outlook. Don't give up on a globally diversified portfolio. And then on fixed income, you don't have to take a lot of risk to get some decent return there anymore, which is kind of a nice place to be. Okay. So, any questions? Yeah.
You had mentioned with tariffs and it affecting exports. My understanding is back in 22, we had negative GDP because of how bad the trade deficit was. Mm-hmm. Will tariffs affect the trade deficit?
Oh, yeah, great questions. Yeah, so in 2022, we did have like one quarter where we had negative GDP. A lot of that was driven by the trade deficit. So, and that's one of the interesting things. So in GDP, gross domestic product, it's one of the measures of economic output, right? It's technically the market value of all final goods and services sold in the United States. A component of that is what are we exporting? And then you subtract from it, what are we importing? So that deficit, so when your imports are more than your exports, that's a trade deficit. We've run a persistent trade deficit. It's just in 2022, it was particularly large, temporarily, thankfully. A lot of that seemed to be driven mostly by imports of kind of some revenge spending was a good part of that, as far as people still buying a lot of goods that were imported. Now, in terms of tariffs, they are likely to make the trade deficit worse as opposed to better if you get the retaliatory tariffs. Okay, so the net effect is zero with tariffs. If, let's say we slap 10% tariffs on Canadian goods and they slap 10% on ours. It's just that it's a lot of face slapping that goes on, and it doesn't really do anybody any good. Okay, but what can happen is if the currencies adjust, where the Canadian dollar depreciates, we export less. So you don't help your imports and you hurt your exports. So it actually has kind of perversely the opposite effect of what was intended. So it is definitely something to watch. Yeah. Yes, sir. Oh, sorry.
So you've talked a lot about technical aspects of it. We've looked at the rational side. How about the emotional side? What one thing do you think will trigger the markets to take a shift and get that 15 to 20% correction that I think a lot of people have been expecting because of the pricing being high?
Yeah, I'm glad you said shift as opposed to omitting the F, because sometimes that's what people think about when the market goes down. I think I saw Dave flinch a little bit. But what could do that? You're right. The market is driven by emotions, and Ben Graham talked about that. How in the short run, that the market is a voting machine, but in the long run, it's a weighing machine where it's the fundamentals, right? But in the short run, we do have to worry about it, and it's going to be rumors. It's going to be probably some off-the-cuff comment or social media post that happens, but then does that fear become a reality? So in my reading of market corrections, which tend to be a decline of, let's say, 10%, 10 to 15% of the market, versus a bear market, which is 20% or worse, is that the corrections are driven by fear. Fear of inflation, fear of growth, or fear of geopolitics, or some combination, right? So it's that fear that can drive the correction. If the fear becomes a reality, then the correction becomes a bear market, right? And that's where I think, what could the fear be? We don't know, and that's just, unfortunately, the price of the ticket, right? The possibility of that. It would not be unusual. I think it's like every year or every 18 months or so in the market history, you do get a pullback of 10% or more. We haven't had that in a while. Not to say that we're destined to have one, but it could be a fear. Let's say, one of the things, what would be a rational fear that might not become a reality? It could be about, let's say that there is the threat of a tariff significantly more than what was anticipated. I think the market is pricing in, based on currency moves, probably a 10% tariff on Chinese goods, because the Chinese currency has already gone down about 4%. And that's pretty consistent with that what we had in 2018 to 19. So if all of a sudden there's an executive order that says it's going to be 20%, right? So it's like, oh, he decided to go big. That's probably what one of the bigger fears could be.
Brian, I was going to say thanks for your very balanced view on the tariff issue, because it's a little bit more complicated and nuanced that I'm going to put tariffs on you and the price is going to go up.
Yep.
I think you know that, and you were trying to explain it very well. But it's also true, I believe, that most of the countries we're talking about imposing tariffs on, we have a trade deficit with them. Because if we didn't, then it would not make any sense. But we do have a trade deficit with them. So their notion of buying less from us is not as valid as...
Yeah, that's a good point, is we have the bilateral trade deficit with them, and it's there for a reason, right? It's not as though it's just because they are undercutting U.S. producers. It could be for any number of very valid reasons. I think of coffee, right? We can make coffee in the United States. I think Hawaii, they grow some, but there's not really a lot of good stuff or areas to grow coffee in the United States. And so we're probably going to have a trade deficit in that good with a particular country. I oftentimes like to think of the trade deficit as also reflecting the foreigners' willingness and desire to own U.S. assets, because that's the flip side of the deficit, right? They get on net more dollars than so it increases because they are exporting more to us than what they are importing from us. So with those dollars, they want to own U.S. assets. And is it land? Is it treasuries? Is it U.S. equities? And so one way to think about a trade deficit is there is no real deficit, because there's this thing called the balance of payments. Any trade deficit is offset by a capital account surplus. And so a lot of the currency moves and the trade deficits could reflect the desire of foreign countries to own U.S. assets, because the U.S. is a great place to own assets.
Do you have any outlook on quantitative tapering?
Oh, yeah.
Interest rates?
Yep. So with the Federal Reserve, not only are they adjusting their policy rate, but they're also shrinking the size of their balance sheet. So quantitative easing is when the Fed went out and was just buying stuff hand over fist, right? But they have been shrinking the size of their balance sheet, allowing those assets to mature and kind of roll off subject to certain caps. So they don't want it to just roll off completely. They are likely going to want to stop that probably towards the end of the first quarter, beginning of the second quarter. I thought they would have already wanted to stop it now, just because in the past, like if we think about the last time they did quantitative easing and then the tapering, the tightening of policy, they stopped at a level that I thought is pretty consistent to where we are about now. So I kind of figured that might be the target. Apparently they're going to let it run a little bit more. I think until we see something go on in the banking sector with overnight borrowing between banks, because that's where you kind of see the stresses pop up, that's been pretty well behaved. So until they're seeing signs of maybe some stresses in the overnight funding market for banks, they might see how low they can go. I just don't want them to go too far, right? I'd rather them be like, okay, now it's close enough. It's like, kind of like approaching the edge of a cliff, right? You could go all the way up to it, right? But what if you fall off? I'd rather they stop a good, like 10 to 15 feet back. All right. Well, thank you, everybody. I really appreciate it. Enjoy the sunshine despite the bitter cold.